now.
All right, wonderful. So good evening, everybody, and welcome to session 3. This is kind of a more applied part 2 on, so we call it how to pick stocks, but it's to do with ratios and kind of finding investments from a bottom-up fundamental perspective. My name's Henry. I'll be leading the session, and I'm co-hosted by InvestStock President David, who's here, and Amrit will be joining us soon. Yeah, as I said, David, I'm leading this one, but anything you kind of want to jump in on as we go through, then please do.
Right.
Yeah, again, I'll ask this the other way around, but was anybody not at session 2?
Put it in the chat, just turn on your mic, let us know.
Chat, anything.
No, I wasn't there for the first sessions.
Sweet. Okay. Awesome. That's it's not much of a prerequisite, honestly, but we've got all the stuff on YouTube, which is great, and it's good to have you join us here, Max.
It is. Yeah, I'll definitely have a look at the previous videos later on. Yeah.
Wonderful.
Right. I think it will kind of reinforce and help what we're going through today. So
cool.
Okay, perfect. So yeah, I give recaps of kind of the previous sessions at the start of the sessions. Right, so what are we doing today? Yeah, so basically, welcome. We're doing recap on the basics of financial statements and ratios. I've got some really fun real world examples for you guys about how you can use ratios in your investment decisions. And for the last bit, we're just going to take this freestyle interactive. We're going to kind of do a filtering game where we're going to use ratios together to pick stocks, which is going to be pretty good fun. Again, just because a few people aren't here, I'll briefly introduce myself. My name's Henry. Yeah, I've got a bit of financial experience and kind of mainly on the buy side, which is like in investment analysis and kind of researching stocks and working for funds and that kind of stuff. Got some corporate experience in the bank as well, doing sales and trading and equity research. And yeah, currently last year UOB and managing my own investment portfolio. So that's me. Yeah, so before we start, again, I've designed this to be as interactive as possible. I'll be stopping every few slides for questions, and I encourage people to ask it as they go. Yeah, if you want to ask anything, just shout. And David's going to be monitoring the chat as well. So any questions, just go in there. Second thing, I study economics, and I learned barely any of this from my degree. This is very, very practical finance. It's not what we get taught in kind of economics and finance degrees at all, really. So it's not a prerequisite. And actually having a diverse skill set with this kind of stuff actually helps quite a lot. Is that okay? That's all fine. Yeah, that was the theme that David and I were really pushing for this year. Particularly, David studies history with a Spanish minor. And we've built a very diverse committee, particularly in terms of subject, which we're very happy with. Thirdly, yeah, this is just a disclaimer. The Investment Society and Henry Garden Roberts takes no responsibility for any third-party decisions, nor does any material constitute as financial advice. When investing, the value of your investment may go down as well as up, and you may get back less you invest. There's no kind of financial recommendations in this presentation anyway, but I just want to say that. And feel free to get in touch after this presentation with either me, there's my full name, or the rest of the committee, with kind of any feedback and what you'd like to see going forward. Okay, so as I touched on, this is a very practical expansion of session 2. Hope to use some more real world examples. I'm going to be talking, the bulk of it is about one of my past investment theses, basically, and kind of talking about how to use these ratios to come up with a stock selection. David, just checking, is everything all right with my audio and my video?
yeah, perfect, man. I can see you. I can see the slides. If anyone can't see Henry, then at the top of your screen, if you're on your laptop, there should be an option somewhere saying gallery view, and then you can see all of us down the side, and you can see the slide in the middle, but I can hear you and see you, mate.
Perfect. Wonderful. So this would be useful for anybody who wasn't at session 2. This is a really basic recap, just very, very basic accounting. There's 3 financial statements: income statement, balance sheet, cash flow statement. They all kind of link together. Very, very simply, you've got the income statement where you've got earnings that come into the cash flow statement. Bottom line of the income statement is called net profit. That's the profit after all your expenses have been taken off. to produce that profit. All your tax has been paid, your interest has been deducted, etc., etc. That feeds through to a cash flow statement, which is like the company's bank account. It records the actual transactions coming in and out the business. One reason why the bottom of this and the top of this might not be the same. I mean, yeah, I'll go into it very quickly because I think it's important. I mentioned it in the last session. Just things like, say, for example, there's this thing called depreciation, right? Where a company would say, buy a factory. They might purchase that factory for 1 million. And that gets recorded on the cash flow statement, right? Because you physically paid 1 million for this factory. What the companies do in order to smooth out that cost of buying factories is they would say, put that on the income statement, and they would base it off how many years it would take the factory to depreciate on its remaining life. So say if it took this £1 million factory, it's quite generous for a factory actually, £1 million. But yeah, say if it took this factory 10 years to depreciate, they would put a depreciation expense of 100 grand a year on the front of the income statement. That's not real. Like, they do it to smooth out the earnings, but it's not the real cash that's changed hands. Therefore, on the cash flow statement, these depreciation charges are added back. That's one example. Second example was something I talked about in the last session where, you know, if I had a business, somebody might pay me on credit. They might say, look, I really want you to do this for me. I don't have the money now. I have the money next month. Can you do it for me now? That would be logged on my income statement as profit, but because I haven't received the cash yet, it's not logged on the cash flow statement. So that's basically why these two differ. They're quite similar, but the income statement is more profit and loss. The cash flow statement is, here's the actual money that's coming in. Here's how we're spending it. That feeds through to the balance sheet. So how you spend your money shows your assets and your liabilities. You know, if you pay off debt from your cash flow statement, the debt on the balance sheet will reduce. If you use the cash to, again, purchase the factory, that will then show up on the balance sheet as an asset. And then obviously these assets and liabilities work in conjunction to build the company that produces the revenue on the income statement. So that's probably explained as simply as I can for this session. But does anybody have any questions on these financial statements before we move on?
Again, with that, feel free to just to drop them in the chat, or you can turn on your mic. Completely up to you. Good recap there, Henry.
Yeah, that's cool. I just thought it was important.
No questions so far. If you have a question at any point throughout, just drop it in the chat and we'll get to it.
Wonderful. Okay, so this was the other main thing we talked about last time. These were Amrit's slides. He did the second half of the last session, again on YouTube. He talked about the ratios and broke them down into four main categories: profitability, liquidity and solvency, so relating to debt, how a company can meet its borrowing obligations; valuation, looking at how cheap or expensive it is in the market relative to what the current shares are trading at; and dividends. So dividends, again, they're kind of the profits that companies pay out to shareholders, looking at the dividends, seeing if they're sustainable, etc., etc. And we can use these as a big part of an investment thesis. It's very quantitative. It makes stuff so easy to analyze. It basically makes these three financial statements that you see incredibly easy to analyze. Like, that's the main basis of all of this. Okay, so the case study tonight is comparing airlines. These are all US airlines. In fact, they're the 5 kind of major US airlines. I think JetBlue is quite big as well. Has anybody ever been on one of these airlines in the US? No?
Yeah, we got a couple people saying yeah, they have.
Oh, interesting. I'm interested to know which ones and what your experience was, because we're about to give some of these companies stick and praise other ones.
Killian said American Airline is quite common there.
Americans, yeah. One of the biggest.
Southwest was okay.
Interesting.
Okay, nice.
I'll tell you now that the Wall Street Oasis rankings show that Southwest, Delta, and Alaska are much better than American and United. But yeah.
Well, someone in the chat just said Delta's always late, but it's Wall Street.
Yeah, interesting. Let's check that when we get to the table. I'll be interested to see if the data stacks up to that. But yeah, let's have a look. Okay. Right, so I thought airlines would be a good one to focus on tonight. I wanted to give you guys all some context before we just hop into looking at the ratios to kind of, one, give you motivation to understand the ratios, and two, to actually show you a bit of how, you know, how the investment thesis was kind of built, give you all some context. So, okay, I'll read this out, but this is kind of what I typed up at the time as the real basis of the thesis. Airline stocks have dropped significantly since the outbreak of Corona. So the lowest one dropped by 46%, which I think was Southwest, and the most dropped to 80%. I think that was United Airlines. While some of these companies will suffer significantly and even go bankrupt, the most financially stable will survive, and demand for airline travel will eventually return to pre-Corona levels once we get to 2021, 2022. It's unlikely to be early 2021 now, but you know that this is what I was writing back in May. Most have received grants and loans from the government that will tide them over. If we take the 46% decline, that's 217% of potential upsides. That's 1 over 46%, so just over double. Even if the least systemically hit returns to pre-Corona levels. Yet, while the short-term pain from the pandemic has nearly been universal, it'd be wrong to conclude that airlines will experience similar damage to their long-term prospects. Instead, those that enter 2020 on a stronger financial footing will be able to seize opportunities to improve their future profitability and competitiveness. By contrast, those on shakier ground, no pun intended, will have to prioritize short-term survival. So basically what I was saying here is that the airline stocks fell hugely, and like, who are we kidding? Are they all going to go bankrupt? Probably not. So if you select the ones that are the most financially stable using these ratios, then you've probably got yourself a fairly decent investment thesis, providing that they're undervalued, cheap in the market, and they can survive Corona, not only from a quantitative measure, but from a qualitative measure and a business model measure as well. So that's the key aspect of the thesis we're looking at here. You know, trying to find the ones on strong financial footing that will survive. Because what you got to remember as well, you know, and this happens a lot in business, is that, you know, in recessions, the best companies in the industry, they often do very, very, very well. You know, is there more demand for their services overall? No. But is there more relative demand when the weaker competitors go bankrupt? Yes. You know, if there's only, say, 80% of total demand in a recession, but half the companies have gone bankrupt, you're taking up a much bigger piece of a slightly smaller pie. And that did happen with the airlines in 2009, 2007 to 2009. Yeah, some really suffered, and it led others to gain market share. So that's what we're going to focus on today, is kind of this micro part in the thesis that I've highlighted. Okay, any questions on what I said there? I will be covering a lot more of it in detail, but
just whilst we wait for questions on that, I'm just going to jump in on that point, if that's all right, Henry.
Yeah, sure.
In the, you know, early Corona days, everyone was quick to dismiss airlines, say, oh, they're all going to go bankrupt, all going to file for insolvency. But it is survival of the fittest. You're right about those in the strongest position will continue to succeed, because ultimately, you know, airlines are going to be here for a long time. That we're not just going to end up not being able to fly anywhere within the next like 5-10 years. There's always going to be a supply until at least there's a more kind of environmentally friendly option. So I think what you're arguing is a very, very good point.
Thank you, mate. It's what you would call a very contrarian point. Like, you had to be ballsy to do these things. But yeah, you know, they often work out. In this case, it worked out really well. I had time horizon 2+ years here. That's not true at all. Well, it was, you know, this was written back in May, but in hindsight, I actually sold half the position back in June, because it worked out way quicker than I thought it was, and I sold the other half last month. So I'm out of this now, but this was kind of my thinking back in May. Okay, so here we go.
Yeah,
So,
we've got a quick question in the chat from Abdullah, which says, is the gist of it that less choice equals more purchases from those who remain?
The gist of it is, do you mean in terms of like profitable companies gaining market share?
I assume so. I assume it means that when there's, you know, there's less competition, more people are investing in the big ones.
Basically, yeah. So basically, what I meant by that, if I'm getting at your question right, is that when an industry faces real hardship, you know, the weakest competitors in that industry are very, very quick to cut costs, cut business, and a lot of the time they even go bankrupt. So even if the absolute pie of the industry is shrunk, because there's less companies competing in the industry, because the weakest ones are already fucked, then the ones that remain have a greater piece of the pie, is what I was trying to say.
Yeah, for sure. For sure.
Yeah, cool. Let me know if that didn't answer your question, and I can get back to it. Right. Okay. So here we go. S&P 500. For anybody who doesn't know, this is just an aggregate of the top 500 companies in the US. It's what you call a capitalization weighted index, meaning Apple and Microsoft have more of a impact on how the share price goes than some of the smaller companies. But as you can see, you know, airlines, they weren't setting the world on fire last year. But you know, when this Corona came, and remember, this was a massive drop. If anybody can remember the exact percentages of this drop, well, I don't know what it was off the top of my head, but looking at the graph, it looks like something close to 50%, at least for a short while. But the airlines, you know, this is an ETF, so it's an average of many US airline companies. This absolutely went to the floor. So, you know, you thought the drop in the S&P was bad. Look at the drop in airline shares. It was absolutely crazy. Absolutely crazy. I started looking at it around about here. What was the date on it? May the 17th. So I started looking at it just as it was kind of turning around a little bit. But this was absolutely catastrophic, you know, in terms of a play. And a good thing from individual investors is like institutional investors, because they're under so much pressure from each other. Like they so often follow herd mentality. It's so difficult to run a contrarian investment thesis if you're mainstream in an institution. Just because if you go against the herd and you're wrong, you know, not only is your bonus at risk, but probably your job, you know. But if you go with the herd and you're wrong, no big deal. Everyone else is wrong. So airlines got drastically oversold. Any questions?
Yeah, Henry, we just got from Finn in the chat, which is, what are the green bars at the bottom of the chart? Is it volume of shares trade?
Testing.
Did you hear me? Did I cut out? That's probably me.
Volume of shares traded.
Yeah.
Yeah, that's what it is. Yeah.
Okay, cool. In millions, I'm guessing.
In millions. So
Yeah.
so what you can see, I think it's millions of pounds. Yeah, it must be. It's either that or millions of shares. Take that with a pinch of salt. But what you can see is that the volume was very, very low and stable. And then all of a sudden in March, everybody took note and everybody sold. And even when this was flat, you know, well, pretty flat, everyone was still trading it like a madman in terms of volume. Yeah, that's what
so we just got a great question from Joe. I'll read it out, and then Amrit said he's happy to take it. The question is, do you know how the S&P decides which stocks go in the S&P 500? He says, I thought it was always the 500 biggest, but Tesla's jumped straight into the top 10.
So, guys, can you hear me?
Yep.
Okay, cool. So this is kind of really interesting. So the S&P 500 is like the questioner said, is the 500 biggest stocks trading in the US. It's a private company, S&P, so they can decide whoever they want kind of in the index. There's a specific kind of inclusion criteria. So if you actually want to see it for yourself, it's a PDF. Just type into Google S&P 500 inclusion criteria. Basically, long story short, it has to be a US company. I'm just looking at it now. US company, market cap of more than $8.2 billion, be liquid, have kind of a liquid, guess like, you know, amount of shares traded. And it has to have kind of two things which are kind of important for Tesla. A public float of at least 10% of its shares outstanding. So that means at least 10% of the company is traded kind of on the stock market. And then the really important bit, which is for Tesla, needs to have the last 4 consecutive quarters, you know, a profit registered. And so that's the thing with Tesla. So Tesla is a gigantic company. I'm not sure what the market cap is. I want to say it's like 200-300 billion. I think it might be even more. But it didn't generate a profit. And there's been a lot of controversy kind of considering over the last 4 quarters as to how it's generated a profit. But long story short, the last 4 quarters, there's been a paper profit for Tesla, and now it's kind of accepted. So that's why it's kind of in, that's why it kind of jumps up straight to the top. It's already grown so much outside, so it enters at that highest level. So I hope that makes sense, and If you guys have any more questions on that, I can answer it.
Yeah, cheers, Amrit. We've had one more, Henry, before you move on, from Jacob Brown, which is the green at the bottom, is that the volume for the airline companies or for the S&P as a whole?
Oh, that's for the airline ETF.
Great.
Yeah, that's for the airline ETF. I imagine the volume for the S&P, you know, there wouldn't be such a difference between pre-corona and post and during corona. So obviously with the S&P, there would be an increase in volume, but it wouldn't be as drastic as this at all. Yeah, so the volume at the bottom is for the airlines ETF jets.
Great. All right, next one.
Cool. Right. Okay, I think that's everything I wanted to say on that. Yeah, okay, let's carry on. So just a very, very quick background on airlines. I just wanted to go through this again to give you some context. They're not the greatest sector for economic moats. What I mean by economic moats is where companies have a competitive advantage. I'm sure a lot of you have heard of this term, but if you think about, I don't know, you could think about anybody. If you think about Apple, right, they have a very impressive competitive advantage around their brand. You know, Apple is probably one of the strongest brands in the entire world. There are many strong brands, but Apple's the first one that came into my head. They have a strong brand around like switching costs. If you have all your Apple products and apps integrated, it's then a pain to switch over. So that, you know, things like that, like bio and pharma companies have patents which stop other drug companies, you know, selling the same drug. But airlines, they're not so great on all this. Like, they have very high initial costs, i.e. it's very difficult. It'd be very difficult for David, Amrit and I to go and start leasing a plane. You know, we could probably set up a lemonade stand and compete with Joe's Bar pretty easily tomorrow. But, you know, leasing a plane and getting the permits from the airports and doing, you know, hiring pilots and all that is very difficult to do. But a large capital requirement is pretty much the only major economic moat that they have. So what this means is that, like, from a business fundamentals perspective, they don't tend to be the greatest industry. You know, if we're going to fly Florida to Orlando, what am I talking about? Florida to some other US state, you know, we would typically just look at the cheapest, most convenient option. There wouldn't be huge incentive for us to go for brand or anything compared to a lot of other industries. It's slightly underperformed the S&P. And this is a key thing here. It's highly operationally leveraged. So Amrit touched on this last time. It means you have a high proportion of fixed costs to total costs. So what that means is, if you imagine when your revenue declines, your profits are going to be very, very sensitive to change that revenue, because you've still got a lot of costs to cover, but your revenue is going. If it was variable costs and it's like, oh, you know, less customers are coming, let's just produce less things, that's easy. But, you know, if you sell your tickets on an airline for 80% of the price, you've still got to run the airplane. You know, if you only sell 80% of the tickets, you've still got to run the airplane. And most of the time, if you run an airplane that's 80% full, these companies are operating at a loss. So that's just a bit of context on the airlines. And this was quite an interesting one. This was one I did an opposite to Buffett, who's usually a contrarian. In fact, I did have a quote by him right here. But yeah, he actually may just sold off the airlines just a couple of weeks before I bought them. I mean, and there are various reasons why Buffett and I might have disagreed on this slightly. You know, he said if the business comes back 70-80%, the aircraft doesn't disappear, you've got too many planes. I would say that's largely true. But my whole argument would be, if the business comes back 70-80%, a lot of the airline companies that are already fucked will get fucked, which is more than 20-30% of them in terms of market share. And then that leaves the remaining percent room for growth. That would be my kind of rebutment to why Buffett went short on the airlines. He had big positions in all four of the big US airlines. You can see here, American Airlines, Delta, Southwest, United on the little text here. But yeah, so that's Buffett. And in fact, you know, when he said, oh, I'm selling all my stake, it actually catalyzed even more decline in kind of this airline bear market trend. Okay, any questions?
Yeah, we have one from Joe again, which was, what are you classing as the last market cycle?
Oh, back here.
Like
Yeah.
this.
what I mean by the last market cycle is from the end of the last recession to kind of this recession. So kind of 2008 to 2020. They were doing okay. Like airlines were doing okay back in kind of the early teens, from what I seem to remember. But overall, their performance wasn't particularly great.
I think that was a good point as well about competitive advantage, you know, brand loyalty. No one's got loyalty to airlines, I guess, unless you're flying like British Airways and you want their first class. Like, you know, you usually go for budget, whatever you can afford, the cheapest route. So I think it's really interesting with airlines. You know, it's not like as you said, Apple, which is probably, as you said, the strongest brand in the world. I think airlines are a very, very fascinating case study. So I'm excited for what you got coming up next.
They're interesting. I mean, there's a reason why they've got so many loyalty programs. Like, there's a reason why like half the credit cards in my wallet are airlines, right? And that's purely because they need anything they can to rope me in, like anything. Right.
Exactly. Because I guess on the face of it, you know, what's the difference between EasyJet and Ryanair? Yeah. Or that there isn't. Not
really. I mean, this goes into the thesis. Like, there's a lot of airlines that have kind of differentiated themselves through very, very high-end air travel. I would certainly argue that they're not going to do the greatest in the future, because most of the people that can afford the ridiculous prices are businesses, right? And I think passenger demand for airlines is going to be quite consistent with people going on holiday and moving around. But business, you know, look at all us over Zoom. You know, what kind of business is going to pay 20 grand to have someone sleep well on Emirates, you know, when they don't have to, you know? So not that will go away, because I know that face-to-face meetings are still important, but I think it's definitely going to decline. So there's going to be even less differentiation in terms of what services they offer, whether it's a 20 grand seat or a, you know, 200 pound seat.
Sure.
Here we go.
There's a question here, just from Tom, just discussing, is airport slot ownership not a barrier to entry for airline competition? I've got my thoughts. Do you mind me jumping in?
Go on, mate.
Go for it.
I think it's a feature of the industry, I guess, personally. I mean, it's a barrier to entry if you don't have an airline and you're trying to enter the industry, because you have to get a specific slot for an airport. But between airlines, I mean, if you have a slot at Heathrow or you have a slot at Gatwick, you know, you're still flying kind of London to wherever, so the route is still the same. And then kind of, you know, as such, you know, I'm not really going to be that fussed, you know, flying into Heathrow or flying into Gatwick. You know, I'm going to be, you know, looking at the price. So I mean, I guess those are my thoughts on that question. But what do you guys reckon?
It's certainly a big barrier if you don't have an airline, as are a lot of things. You know, like Richard Branson famously said, how to become a millionaire is become a billionaire and then start an airline. That's exactly what he said with regard to Virgin Atlantic. But once you are actually an airline, I don't think the costs of kind of getting slots at airports is that much. From what I seem to remember, looking at the income statements of these, most of the costs are either paying the pilots and buying propane. I think. I don't think that the airport kind of slots are a big part of their operating expenses.
It's not an expense as much as it is a bit of a regulatory and registration nightmare. But yeah. I think you're right. It's not a whole cost issue. It's to do with actually managing to get a slot. And getting slots at airports, especially the bigger ones, is very, very challenging and competitive. And I know that for sure.
Interesting.
Okay. Well, this slide says comparing two airlines. To be fair with you, we kind of are comparing all five, but Southwest and American for me stood out for two different reasons, and I'll go into that. Okay, so here we go. Here's kind of what Amrit was talking about last time: profitability, valuation, liquidity and solvency relating to debt, and dividends as well. You have to bear with me, but dividends, I'm going to talk about something else, just because all airlines suspended their dividends when COVID happens, just because they needed the money. I can't remember. I think that might have been a government order. I can't remember if it was government enforced or if all the airlines just did it. I'll be interested if somebody could look that up actually. But anyway, they all cut the dividends at the start. And so I'll use something else to talk about the dividends. Right, okay, so valuation. I have to talk about valuation first because it was a prerequisite for me investing in these airline companies. So I say on the basis of my thesis, there was no point in me investing in an overvalued airline company. The whole idea was bearish sentiment on airlines made them oversold. So there's no point when the macro is so shit. There's no point in going where the micro is also shit. You know, I'm using the macro is making the micro good, if you see what I mean. So what I mean by that is that the bearish macro sentiment is making the individual companies cheap. You know, it'd be pointless buying a shitty investment where they have shitty growth prospects in the market. So look, again, just looking at a couple of these price to earnings and price to free cash flows. Southwest, you can tell Southwest is the one I like. But looking at Southwest, that was actually the kind of one that came out as not most overvalued, but the least undervalued, I would put it, purely on a metrics point of view. Amrit talked about price to earnings last time. That's kind of the multiple of the company's share price over its net profit. And price to free cash flow is the same thing, but with free cash flow. Free cash flow being the actual net profit that's come in, otherwise known as operating cash flow, minus any expenditures to maintain current business activities. So it's basically like your free money to go on holiday or to put into your savings if you're a student. So you know they were actually pretty high for Southwest, but I think the point is that like this shows that the low PEs, you know, they're often good, but they're not always good for the right reasons, in the sense that a lot of the time a stock is undervalued, not because its earnings are great relative to its price, but because its price is shit for a reason. That's what I would say on that front. And okay, so before I go into EPV, has anyone got any more questions or anything to add, guys?
I just got one point, which is the government forced airlines to stop dividends. So you're right.
Was that the same in the US?
I only looked up the US, so the US government said
right.
that.
It was
part of, yeah, it's part of the bailout restrictions.
I thought it might have been, and because the government released a massive like CARES package, and it'd be so stupid if the government were just giving the airlines all this money and then the money was just going out to shareholders. Like that'd be so stupid. Anyway, has anybody heard of EPV? Stands for earnings power value. I didn't want to get too into the technicals of this, but I thought it was, there we go. I thought it was important to mention just because this is how I was very cutthroat on deciding whether to do this in the first place. So I will explain it very quickly. It's a valuation metric similar to, well, it's the same kind of thing as DCF, building a model. It's the same kind of thing as discounted cash flow, but it's something different. And it basically takes the earnings, whatever these adjusted earnings might be, divides it by a discount rate, and that is the current earnings power value. The biggest difference between this and a discounted cash flow is that the discounted cash flow takes into expectations of future cash flows. There's no expectations in EPV. You know, you put the numbers in and it purely tells you how much of the sentiment is based off current market price and how much of the sentiment is based off future expectations. That's literally all it is. So for example, if a company's EPV, say if it was half the share price, right? So you got Microsoft trading at 150 and Microsoft's EPV is at 75. You can interpret that as half of the share price is represented by Microsoft's current earnings and half of it is represented by future expectations. So it effectively shows you how much the market is pricing in future expectations. So that's what I use EPV for. Let me just show you the Southwest specific example. So to just show you really, I don't want to confuse anybody, but I just wanted to show you the basis of how this works. So I calculate something called earnings before interest and tax cash profit. You get the operating profit, you add back the depreciation and amortization, the same that we do in the cash flow statement. We take off the capital expenditure. So this is like operating free cash flow kind of. And then you use a tax rate. If the tax rate is lower than the US corporate tax rate, use the US corporate tax rate just for a margin of safety, because Amrit talked about the thing where the deferred taxes happens and happens and happens. You don't want that to be manipulating this metric. Then you get your discount rate, and then you divide it by the discount rate to get the enterprise value, and then to get the EPV, you add back cash, you take off debt, you take off pension deficit, and then you divide it by the amount of shares outstanding, and then you get the earnings per value per share. If that went over a lot of people's heads, it basically just calculates the real earnings of a business, like the no bullshit earnings, I'll call it. And for Southwest, this came out at an EPV of $48, which is incredibly high considering the price was about 28 when I looked at this. So again, I just wanted to show this to give you guys some context. Some of these airlines, they came out of really good EPVs. The American Airlines, they had quite a bit of loss. So they had negative EPV. And the whole idea is to kind of use valuation models in conjunction with each other. So I did an EPV, I did a DCF, I looked at what all the professional analysts were kind of valuing the stock at. And you get these numbers, you think, oh, my EPV for Southwest is coming out at 48. The free cash flow is coming out at 51. And Morningstar value it at 42. If the share price is 28 and these three are quite close together, you've got to think there's some merit in it being undervalued. We can't all be wrong by such a huge margin of safety, particularly using conservative metrics in our valuation models, which I'm very, very pro. So that was it. If anybody's curious, the reason why you see this discount rate being quite low, 7%, Southwest were in barely any debt. So when they did issue more debt, Moody's were like, oh, Southwest credit rating is really high. I think their corporate bonds went on for about 4 or 5%. When for an airline, given what we've seen, was actually quite impressive. The other component of this low discount rate was that there was a low beta compared to the other airlines. So the volatility of Southwest share price was lower. As I mentioned, it had the smallest systemic decline, 46% versus 80%. So therefore the beta was lower. So the equity thing in the capital asset pricing model was lower. So that's why you have a low discount rate. But back to basics.
Wait, Henry, sorry, very quickly. We just I got a private question,
Yes.
Which is, how can we calculate WACC, discount rate? How do I do a DCF? How do I build an EPV model? And that is definitely something that we're going to cover in a future session. I think maybe towards the end of December, before Christmas, or even afterwards, we'll get a bit more technical and actually kind of walk you through one of these models. I think it will make it more interactive and help, right?
Yeah, it would certainly help. I appreciate. I'm sorry, guys. I appreciate. I have to explain. The thing is, I have to explain it, but I can't really explain it in full detail because it can get quite complicated. But yeah, I think a full session on this would be very, very good. The basis of a discount rate is basically working out how much it's costing a company to issue debt and the opportunity cost of equity. Basically, the two things that I'm using for that. The opportunity cost of the equity goes into something called a capital asset pricing model, which is another whole thing in itself. But that's how I get the discount rate is important. It's a very important thing because small changes in the discount rate are big changes in the valuation. But yeah, we will go through all of that and dedicate a whole session to it. Was there anything else, David?
As far as I can see now, I think that's it for now.
Okay, cool. Right. Okay, so here we go. Number 2, profitability. These are kind of the figures that Amrit highlighted in the last session. So you've got the big 5 here. These 5 are part of the S&P. I mentioned them earlier. The S&P 500, I should say. So here we have Southwest with good net profit margins, good EBITDA margins. So EBITDA is similar to operating. So that's earnings before interest, tax, depreciation, and amortization. So it's kind of operating profit. That's why you see net profit always lower than operating profit, is because there's all these expenses to be taken out, like interest and tax, before you get back to net profit. Return on equity is basically the equity of the business is its net worth, its assets minus liabilities. And it's a percentage of the net profit on that equity. And then return on assets is the same thing, but just on a business's assets. All right, let's play a game of fill in the blank. Does anybody know why we got a blank here? Anyone want to take a guess? I can hear someone typing.
Jacob Brown has said negative question mark.
Basically, yeah, it's basically because it's negative. So, unfortunately, American Airlines, they had more liabilities than they had assets, meaning they actually didn't have any equity or negative equity, which basically renders the metric a bit useless. So my data don't put it in. So that's kind of went on there. The same thing why you would see if you look at American Airlines, which we can already tell is saddled in debt before even looking at the debt thing. You can see its EBITDA is okay compared to the others, but bloody hell, as soon as you go to the net profit margin, it comes down a lot. The reason that you're seeing that, it's not that they pay an extraordinary amount of tax. You know, they're all American companies. It's the I. It's what it is. It's the I. It's the interest. So they're paying loads of interest on their debt, and that's why you're seeing a very small net profit margin relative to EBITDA compared to the other ones. Yeah, that's basically that. Any questions?
I do hear Amrit typing, but I'm not sure if it's related to the question.
Not, it's not related. Well, it's related to investing, but not related to this. So,
well, no worries.
The other thing I'll just mention here is that, you know, net profit, EBITDA, all of these things, they're good to measure across industries. You know, these companies have very similar business models. If you compared this to some companies in the tech industry, these companies would just look stupid in terms of their net profit margins. But obviously, they're not in the tech industry. They all do very, very similar things, which is fly planes. Therefore, when we compare them with a high degree of accuracy. Right, here we go. Liquidity and solvency. We've got 2 blanks here. Anyone want to fill in the blanks?
I think let's pick on someone, just in a nice way. Okay, so there is someone called Erin here. At least I think so. Erin Coleman. There you go. Do you want to choose one?
She might have her mic muted on. Oh no, she is
Okay.
here.
Erin? Okay. Let's choose someone else. Go on. At the top of my screen, I've got Adam Holloway. Adam, any ideas?
It's literally just left.
Okay,
Right.
Okay, let's go for one more, and if not, then let's go. Okay, Finn Doyle. Any ideas? Please don't leave.
It's fine if you don't want to say, by the way. It's cool.
Message in the chat. You don't have to speak.
Yeah, no judgment whatsoever.
I'll go through these in the meantime. So you've got total borrowing. This is basically, it doesn't say the same thing, but it was one of Amrit's favorites, debt to equity kind of ratio. So you can kind of see here that Southwest and Alaska, they kind of have their debt below their equity. But the other ones, they have more debt compared to equity. Here's why American Airlines, its net profit was so much lower. With an interest cover of 4, what that means is that a quarter of its operating profit is going straight to paying off those interest payments on that debt. So that's really eating into their net profit. And then you've also got the quick ratio. What is this, Amrit? Is current assets minus inventory over current liabilities?
I think that's right. Let me get the figure up.
I think it's that. So
Should be.
it's basically like it's similar to the current ratio, current assets over current liabilities, but it shows the current assets that can like definitely be liquidated, right? Inventory can't be liquidated. Like you can't just say, oh, we just need to sell this right now. Like it's not like a short-term investment. So it's like liquid current liabilities. Liquid current assets over current liabilities, right?
Yeah.
Yeah, exactly. And I guess an airline can't just be like, right, we need to pay off our debt. Let's sell 10 planes right now. It doesn't work like that.
They're not very liquid. Hence why we see very low quick ratios here. But again, Southwest is on the higher end and Americans on the lower end. Right, I'm going to fill in these blanks. Total borrowing as a percentage of total equity. Well, shock horror, American Airlines don't have any bloody equity because their liabilities are more than their assets. And interest cover, Southwest, actually, they weren't in enough debt to actually have any interest to pay. So I believe they didn't have any corporate debt until March. And then that's very good for an airline, by the way. And then the government gave them a bit of care package. And then they've issued a bit of debt, but they haven't started paying interest on it. So they've done very, very well on that front.
I've got one point about Southwest. It's actually one of the best run companies in the US. The chairperson, they won an award.
It's coming up.
Oh, okay, all right, okay. Well, I don't want to spoil it, but during this COVID stuff, they didn't lay off a single member of staff. They just they reduced salaries and they kept everyone on board. So, definitely like a good management team there.
Man, they are legends. That goes into a point that I was going to touch on later, but like a lot of my investment research is really, it's not controversial. It's just different stuff that Wall Street analysts wouldn't really look at. Just like really kind of digging into the personalities of the CEOs and kind of, even going on like airline forums and reading about people's experiences and all that kind of stuff. And like, it's all that kind of unconventional analysis that can actually really spell the truth. And things like those awards are very, very, I put a lot of weighting on that. Particularly as you see, I'll talk about it later, but the extent that Gary Kelly won that award was quite impressive. Right, okay, I'll talk about dividends in a minute because I mentioned that all of the, well, as Amrit said, the airline companies, they had to forfeit their dividends, but both, I think all four of them, apart from American Airlines, paid out pretty good dividends before COVID happened. So I'll talk about that in a minute. Oh, here we go. Qualitative airline factors. So let's go through the CEO stuff first. So, and then Amrit, you can add on to anything. So Gary Kelly, 65, I believe. His LinkedIn used to be a picture of him playing the banjo, which I thought was pretty cool. Again, that'd be something else that would add brownie points to my investment thesis that a Wall Street analyst might not. But I think what you're talking about, Amrit, is the Fortune 500 awards. And Gary Kelly, he came third with I think 87 votes. And so 500 companies in the US, big 500 companies, all the CEOs get one vote each, right? 500. He got 87. He came third to Satya Nadella, CEO of Microsoft, and Jeff Bezos, CEO of Amazon. And this dude who ran the airline came third. He's such a legend. Have you got anything to add to that, Amrit?
No, you. I think legend is aptly put. Like, I like the fact he didn't, fire anyone during COVID. So absolutely, he's actually a good person as well. So yeah.
And you know what, as well, I think it's Southwestern. Are they the ones that the air hostesses and stewards they wrap their safety briefings? Have you seen videos of that?
I haven't. No, I think Southwest.
If not, it's worth watching. I'm pretty sure it's Southwestern. It's very adds maybe some more brownie points, Henry.
Yeah, they do. They do.
That's the kind of thing. Like, but like people just wouldn't take us seriously if they said wrap. The air hostesses wrap it. But like honestly, that is the kind of thing that would win customers. If you've got like a family of 8 with 2 children and the children have paddies over, we want to go on the airline where the air hostesses wrap, and it's a much, honestly, because then it's the kind of thing, like that's a better experience for the whole family if the children are happy on the airplane, because children are a nightmare on the airplane. And like then they've won 8 seats because the two children are happier for the whole flight and more content because the air hostesses do a 2-minute wrap at the start. That's really, it sounds stupid, but those are the kind of things that do really influence business.
For sure. I think unconventional equity research is so important. I remember the first piece that I did was comparing Domino's with Just Eat as a takeaway aggregator. Yeah. And I put a poll on my Instagram for all my followers saying, if you had to choose a night out, would you go Domino's or Just Eat? Or sorry, a night in? And having that kind of unconventional approach, I think really, really helps. And it's definitely like becoming more and more conventional now. Just very quickly, Henry, you got about 10 minutes left, if that's all right, to wrap up.
That's just about all right, I reckon. Yeah, it's not going to be as long as last week. Good job I didn't talk about Amazon right now, because that could have gone on for hours. Right. So this slide, which could have been about 25 slides, but I just wanted to discuss some of the more quantitative business model things, because I'm aware this was a ratio presentation, but I did want to go through them just to give you guys some context. And it's always important, just like, you know, don't base your investment decisions just off a good valuation, and, you know, the fact that the ratios show that they're not in much debt and they're profitable. You know, it's very important to consider all these kind of things. So just very quickly, a few more things on Southwest. The rankings by Wall Street Oasis. Wall Street Oasis? No, sorry, Wall Street Journal. They publish it every couple of years. And I'm aware that this isn't very easy to see, but it's basically Southwest, Delta, and Alaska absolutely smash it. And American, you know, American get 9s for most things. They get a couple of 6s and a couple of 7s. But honestly, it's basically of the 5 major ones, Delta, Southwest, and Alaska are right at the top, and American and United are at the bottom. For somebody who says Delta are always late, Delta actually won on-time arrivals, which is quite interesting.
That was interesting, yeah.
Yeah. Right. So that was it. Rankings, forums. As I said, you know, I browsed airline forums and Quora and stuff, just reading people's experiences, and you get enough of them so that you have an unbiased sample. Then it's really, really useful research. Southwest, they're kind of like the Aldi of airlines. They're mega efficient. They're pretty cheap. There's no bullshit. There's no like upper class. And like, I thought this was good, right? You know, if people are squeezed in terms of income when COVID happens, then, you know, it's going to be much better for Southwest. It's much better macro environment. You know, people aren't going to be wanting to spend 10,000 quid on an airplane seat when they can go to Southwest. So they might gain market share from people who go down for the more expensive airlines. More domestic as well. So Southwest, they had the highest percentage of their travel domestically in the US as compared to international. And this is good because obviously the US travel is more essential. Yeah, the US travel is more essential. And obviously people aren't going on holiday so much and they can't, but they still might need to move around the country. Just another point on the budget airline links into there being less work travel as well. Obviously when people fly with work, the work tends to pay for high-end air travel. If that's going down, then those businesses are going to be more impacted, but not so much Southwest. It's very rare that Southwest is used for air travel, for professional air travel, because it's a budget airline. Also, they were very consistent on their COVID policy, like missing out seats, masks on. You know, they had the clearest COVID policy, and they made COVID conscious people feel very safe. So that was another pledge. Then they weren't as hedged against oil. So just very quickly, obviously airlines, they buy futures because oil is so volatile. They kind of buy futures to hedge against oil, which is usually a smart thing because it smooths out your costs. But as oil prices declined, Southwest actually benefited from that because they weren't as hedged against oil. When I say oil, I mean propane, but that fluctuates in tandem with oil. And also the market share change in recessions. I talked about this earlier, but you look at every recession pretty much ever since the 1960s when these airlines were first about, Southwest has gained market share. It went from 7% to 9% from 2007 to 2009, and now it's up to about 11, 12%. I imagine now it'd be even more because a lot of airlines are still fucked, basically. And lastly, before I go for another question break, this is the performance post-crash. So, you know, the thesis didn't play out as incredibly as I heard. No, the thesis played out very well. I was imagining maybe United not to do as well as they did, and maybe Southwest to be a bit further up. But to be fair, you know, Southwest declined much less before COVID. So Southwest is in black. Basically, what we can see here is we can see the S&P returns since the airlines bottomed out. You know, the airlines went super back up, which was a function of them all being undervalued, except for American Airlines, which lags behind, you know, and it's very clear when we look at the metrics, the other ones have been doing all right. And it's American Airlines that have been saddled with debt and not very profitable. And that's clearly played out in the share price, them not recovering as fast as the rest of the airlines. You can kind of see, actually, you can see, if you look at the black line, that's Southwest, you can see where I bought and sold. So I bought most of the position here. That B is Delta, because I bought Delta as well. And then selling there, and then I sold up some more here. Kind of when it got close to my EPV target. Oh, okay. Does anybody have any more questions before we move on to dividends?
We've had a quick one from Joe saying, are you concerned about the widening gap between the US stock market and their economic fundamentals in relation to buying US-based stocks?
Whew, good question, mate. Am I concerned about how high the S&P is relative to
Fundamentals.
Yes, I would say, particularly as a value investor, that's kind of been what I've done so far. It's where I'm experienced. And from a valuation perspective, yeah, I would say the S&P is pretty high. In fact, recently, the cyclically adjusted price to earnings ratio, Robert Shiller's metric, it actually overtook where it was at in 2000. I mean, prices have been rising. It's not so much because prices have been rising so much in the S&P, but it's because earnings have actually gone down quite a lot because of COVID. So I'd say on a historic basis, the stock market's very much overvalued. And that's why most of the stocks in my portfolio are dividend stocks. They're income stocks. They're paying good dividends. I talked about that in my IPG thesis, if you're interested in hearing more. You know, and they're stocks where they're tangibly backed up by a lot of stuff like property and gold and things like that. So yeah, I would say definitely for the most part, yes. I would say it's also a function of, you know, of having a high proportion of companies that are very fast growth companies with the rise of tech. So that's a function of it, and it's harder to price in that growth. But I would say overall, yeah, I would expect, you know, without constituting any financial advice, I would expect that we see a correction in the S&P. Although it's hard to say because we've never had such low rates going into a decline. So yeah, that's a very complicated question, but nice one.
No, great answer. I agree with that. I think really good answer. With 2 minutes left, do you want to quickly try and run through the interactive share pad thing and just miss out dividend?
We could do one very quickly. Like,
yeah.
We could definitely do one. So just very quickly on this point, this is what I filter for dividends. Amrit talked about this amazingly last time, and I've talked about it in IPG. Look at my IPG thesis on YouTube if you're interested in kind of looking at how to filter for dividends. But here's how I do it. Amazon we're going to talk about on Thursday in Alpha Room. Just come with your thoughts on Amazon. No pressure for any presentations. Let's just have a discussion on it because that came top of the poll. And yeah, let's play one round of the weakest link. Basically, if we all build a filter together, take it in turns to choose a metric. We'll start with all of the companies in the S&P global, and then we will see who wins. You know, we'll each take a turn to kind of pick something to filter, and we'll see who's the last man standing. Sound good?
Yeah, sounds great. Let's do it.
Right. Let me just see if I can. You can still see everything, yeah?
Yeah.
You can see my laptop. Right, lovely. Okay, wonderful. I'm going to log into this. By the way, guys, this is not free software, and I will find a good alternative for people to use. But for now, this is a pretty basic way to do it. Right, come on, mate.
There's a question
Hey,
saying, there's a question on do you think there will be a collapse by Joe Wilson? I just want to double check. Does Joe, do you mean the market as a whole, or do you mean airlines?
Market as a whole.
Market as a whole. Okay. I think. Oh, did you ask? Do you mean like based on kind of the disparity between kind of how the economy's doing, the market's all-time highs? Like there's going to be a collapse. Oh, okay. Yeah, and all the debt. Yeah, I mean, like personally, I'm kind of contrarian in that, like, I think the market's just going to keep going up and up and up just with the amount of money printing and the amount of kind of international investment in the US personally. I think the US is, in my opinion, again, this isn't financial advice, but in my opinion, the US is kind of the safest haven at the moment for kind of getting some sort of return. I mean, if you look at the UK, the FTSE 100 over the past like 20 years, it's actually gone down. You know, real returns in the UK and Europe markets are just terrible. Basically, you're looking at like 2-3% if you're lucky. US has managed to kind of, you know, fight the Great Recession in 2008, achieve like, you know, 7 to 10% returns. You know, the Fed is printing trillions and trillions of dollars. That's finding its way into the market. It's finding its way into kind of, you know, rising stock prices. So, you know, definitely bullish in terms of that. are you worried about devaluation of the dollar? Yeah, definitely. When you print $4 trillion, that's going to have an impact on the value. It's why if you look at Bitcoin and gold prices, you know, they're doing very, very well this year.
Bitcoin especially, like crypto is definitely something to be looking at right now. Just conscious of time, we'll do the stock selector with Henry, and then we'll go back to any questions for anyone that wants to stick around.
Sounds good. Thanks for the very, very deep questions. And I like your answer on that, Amrit. Again, for time purposes, I think I will give my 2 cents on that on Thursday, because I think we could all go on about that for quite a long time.
For sure.
Right, let's do it. So, okay, I've made it. Invest stock filter 1.
What, Henry, what you're going to have to do is you're going to have to unshare, deshare your screen because it's stuck on the PowerPoint, and then reshare it with a new tab.
Okay.
If that makes sense. It's because it's only focusing on your PowerPoint.
How's that? Oh, hang on. So I've got to unshare it.
Yeah. And then,
there we go. There we go. Like that?
No. Go on a share screen and click.
It says you're now. Oh, so I have to go stop share.
Right. Yeah. Sorry. And now reshare it, but with that tab.
Right. How's that?
Perfect.
Wonderful. All right, let's do this quickly, guys. This is going to be, honestly, this kind of stuff, I get really excited over this stuff. I'm really nerdy like that, but let's do it. So we've got invest stock filter 1. No filters are up. And we've got, you see here, everyone see this number? This is the key number. We've got 4,790 companies left in the US. And we're going to basically get stricter and stricter until we've got one bit of criteria left. And we'll take it in turns to add some metrics. Does everyone understand what I mean? Yeah. So we'll add some metrics onto this, and we'll keep filtering, and we'll see which company wins the investment society filtering race at the end. All right, awesome. So there's no right or wrong answers with regards to filtering. But does anybody want to go first and kind of pick a metric? I can pretty much do anything that anyone's heard of on here. So just let me know what people want to filter by, and we can go for it.
I'm going to kick us off. I've decided. Let's start off with a PE, a price to earnings ratio.
Yeah.
Of less than 10.
Whew.
Sorry. Yeah, no, that's less than 10.
Okay. So we want most recent value of preferred. That sounds about right. And we're going to put in here max 10. You ready? So we're currently at 4,800. Add criteria. Oh shit, no, sorry. Apply, I think. How do I do it? Apply, there we go. So it's gone down to 669. So David's wiped out over 90% of the market.
Sorry, guys.
Oh dear. Amrit, do you want to have a shot?
Yeah, let's do market cap above 20 billion. There you go. Let's cut out all of like the smalls.
Are you sure?
Am I sure?
I don't know how many there's going to be with a PE of less than 10 and the market cap above 20 billion.
Let's do it and see.
All right. I honestly don't think there's going to be hardly any left as US dollars. All right. So 20,000. 42. There's 42 left.
Very interesting.
Oh, Altria is still there. I bought those shares today.
Oh, nice.
Anyone else want to come up with a ratio to limit us down to 1, hopefully? Feel free to type in the chat or put your mic on. Debt to equity. Yeah, Joe, do you want to give us a figure for the debt to equity? Choose a number.
Sorry a second. I have to build this one manually. It's a little bit annoying. There we go. Okay, what should we do for our number?
It's up to Joe. Less than 10.
Wait, less than.
Well, yes, less than 0.1.
Okay, so it's 10%. So we want a max of 10%.
Yeah.
Here we go. HP.
Hey.
HP wins. Printing company.
He is the winner.
Boom. Look at that.
Interesting.
So wow, you wouldn't think if somebody said to you, there's only one company with a PE of less than 10, a market cap of more than 20 billion, and a debt to equity of less than 0.1. You wouldn't think there's only one, but yeah. But you see,
Crazy.
if we get rid of the market cap, we still got 111 companies.
Interesting.
No worries, Killian. Thanks for joining us, and hope to see you next week or on Thursday at our Alpha Room session, 6:30 p.m.
Alpha Room. David, do you want me to pitch at Alpha Room? I've got an interesting pitch I could do.
I think what we'll do, if anyone here that's interested in coming to our Alpha Room on Thursday and doesn't know what it is, we're basically going to have it's a discussion forum for all you guys. We're going to come up with a topic. So I think we're going to focus on Amazon and discuss it. So feel free to, if you've got any thoughts about Amazon as a company, come share them. We'll discuss it. Maybe Henry will pitch it as a stock. I think it'd be nice. Doesn't have to be too detailed, too advanced like IPG. Just keep it very, very simple. Reasons for, risks, and just to give people a bit of a background, and then they can discuss kind of from that. And we'll do that. We'll do that at 6:30 p.m. on Thursday. Very, very informal. We'll put the Zoom link in the WhatsApp chat. I'll send an email around on Thursday just to remind you guys. Again, thank you, firstly, Henry, for leading the session. It was great. Sorry, as always, sorry for rushing you as always. Amrit, again, thank you for your contribution, and thank you to everyone that turned up tonight. I really, really appreciate it.
Honestly, anyone who wants to stick around for questions now, please do.
For sure, 100%. If you're not,
yeah.
I was just going to say, if you're not a member of our society, but you're here and you're a UOB student, I've just put the link in there in the chat to go sign up. We're on course to hit 500 members before Christmas, which would be crazy. We really, really appreciate your support. And so please help us out and let us achieve that goal. Anything else from me? Probably not. If you're not following our blog as well, you're not subscribed to it, go subscribe to it here. It's uobinvest.org. And we really appreciate the support with that too. And yeah, Henry, if anyone's got any questions, feel free to ask either myself, Henry, or Amrit now. We'll stick around. Otherwise, have a great evening and thank you for joining us. And thank you again, Henry and Amrit, for running the session.
Take care, guys.
You're welcome. Take care.
See if we've got any
I think
questions.
that's okay, Henry. I'm interested. What do you think of the disparity with the market at all-time highs and unemployment growing and wages low?
Man, is such a question. Are we still on record, David?
Yeah, we've actually just got a question from Joe, which is sorry, and then we can go back to thoughts on market disparity. It's do you get your financial data from a website, or do you go through financial reports?
Good question. So basically the idea is I use this as a shortcut. It's SharePad. It costs me £300 a year. But most of the time I will at least, a couple of times go into the financial reports for income statement, balance sheet, cash flow statement, and check that this lines up just to make sure. This data ultimately comes from Thomson and Morningstar, so it's pretty reliable. But for the more obscure stuff, for example, the interest rate, for example, like Southwest, right? I need the interest rate on its corporate debt. I need how much of its propane is on futures and how much of it is floating, and all that kind of jazz. Then I would go into the financial reports, and that's a very important thing to do. If somebody's researching a company, one of the first things I'd advise them to do is go on and watch the earnings calls, like go on and watch the most recent earnings call. And pay particular attention to the questions, because I'm going to go on a bit of a tangent here, but it's an important tangent. Pay particular attention to the questions, because it's all well and good watching the presentation, but at the end of the day, the company are putting a positive spin on it. They're putting an objective spin on it, but obviously they're trying to paint everything in a positive light. They're not lying, but they're kind of making things sound good. And it's always important to see where the analysts that have done this job for years are digging in to the company. So what I would say is, yeah, I get my data from here. I get it from the financial reports on the company website, but also go watch the earnings calls and see which questions the top analysts on Wall Street are asking the companies.
I think that's a great point. I think if you can afford a platform like this, or you find one for free that's similar, as we said in previous sessions, UOB students can get Bloomberg for free. Amrit, you said Thomson One is free.
Thomson One, yeah.
It's a great resource, but at the same time, you can just use financial reports. I think it's finding a balance and kind of what resources you have as well. But financial reports is probably the best place to start, as well as earning calls. I'm going to take us off record. Very, very quickly before we do, we've got one more question from Hash Power, which is, do you also look at management guidance in annual reports, investor presentations, or management videos? And what do you look for in these? I'm happy to take this if you want, or
go ahead, man.
You know, I think 100% you want to see, you know, what the management outlook is on a company. Obviously they're always going to say, you know, we've got a bright future, blah, blah, blah. But you do want to look at what they're saying, because the management reflects the company. They're the, you know, the most important people. They are the figurehead of the company and the kind of the public reflection. I don't know how to put it, but you want to see what they're saying, because ultimately you want, if you want to invest in a company, you want to be confident in the management, because they're the people that are leading it. So 100%.
I've got one point to add. There's a well-known recession tracker that tracks pretty well with recessions, which is CEO like leaving statistics or something. So kind of at the start of this year, before COVID and all that, we had a kind of a record number of CEOs kind of leave their position in publicly traded companies. So, you know, it's definitely kind of, you know, it's good to just take notice of kind of, you know, management decisions and kind of changes and stuff like that. For
sure. Like even things like compensation, you know, salaries for the management. You don't, like, you want to be looking at that, because you don't want to see these companies increasing the salaries of their top bosses when the company's had a bad year. Stuff like that's really important.
You want to make sure the incentive is there. The incentive can be too much there sometimes. Like if a CEO has too much of its bonus invested in the company, and then they try and push up the share price in the short term. But yeah, I agree. Those are all important things to look at. One thing I would add is that I often find the guidance to be quite conservative. Like I would say most companies are quite good at giving conservative guidance. So if you're ever using it to conduct your own analysis, don't be too scared. You don't have to put a huge margin of safety on management guidance, in my experience, because the guidance, it doesn't tend to be too overinflated from what I've seen.
For sure. Just whilst we still have,
same with analyst guidance, about 65% of earnings beats expectations. 65%. So analysts are deliberately a bit conservative, so that when an earnings report comes out, the stock price goes up.
Sure. Just going to say, whilst we still have 11 people here, which is more than expected at this point, once we've already dismissed everyone. It'd be great to hear if anyone's got any. Can you still hear me?
Yeah, we can still hear, mate.
Yeah. Just be great to hear if anyone's got any requests for future sessions. We're just in the process of compiling like a schedule, a calendar for future sessions, so everyone can see, you know, what we're going to be discussing when. So if anyone's got any requests of what they want to hear, just drop it in the chat. Tell us with your mic on. It'd be great, just because we want to make these sessions as kind of suited for you guys as possible. And with that, I'm going to turn us off record.